Good day to you, Travis. Today is October 3rd, and we're all patiently awaiting to see what the House of Representatives are going to do on this vote that the Senate sent over to them on this federal rescue bill we've all been talking about and debating about and arguing about. So that is probably going to come out here probably early afternoon here, if not sooner, Pacific time, maybe a little bit later on the East Coast. But that's going to be interesting to see if that's coming in. Right now, the traders are anticipating that to pass, and so the stock market's actually on a rally. It's been ranging between 220 and 250 up on the Dow with this anticipation. So if they vote it down, I imagine we're going to see a huge reversal of being up 220 and probably the biggest drop ever, based on being up so high and probably closing much lower in the 500 to 600 drop range. So interesting times. Also, the jobless numbers came out, payroll numbers came out from employment department, and it came in a lot worse than expected. They expected a bad number to begin with at 105,000 jobs lost, but it actually came in at 159,000 jobs lost. So year over year, we're at 760,000 jobs lost in 2008. Not a real positive number at all. Pretty dismal, actually. It didn't affect the unemployment rate. They did have some revisions in August and September of a few jobs, less jobs lost than they had expected. So unemployment is still at 6.1 across the nation. Obviously, a number that's much higher than it has been in recent months. So the economy is continuing to have problems. Also, because of that, usually when jobs numbers come out, it's for whatever reason. I mean, there's technical reasons behind it, but to make this a quick synopsis, mortgage-backed securities actually rally, and you'll see a jump in pricing for mortgage-backed securities, meaning your rates will actually go down. And that was not the case today because of another inflationary factors right now between the Fed Bank and the global economy with different Fed banks around the world. They're all basically discussing and deciding to drop the Fed funds rate and global rates, which are on the short-term rates. So don't get too excited. What that means is short-term interest rates will drop for things like credit cards and auto loans and things that are really bound up right now that aren't moving, the cash flow in those areas. But what it does, it drives up mortgage-backed securities or long-term interest rates. And so if you hear the Feds talk about cutting rates or maybe even a misleading mortgage commercial, it is very misleading because they actually work in inverse directions. When short-term rates go lower, mortgage-backed securities typically will go up because the worst enemy of mortgage-backed securities is inflation. Because if you buy a 30-year mortgage, a note for 30 years, you expect the value to be somewhat similar or to continue to gain over 30 years. But if inflation is out of control, that note will be useless or basically not valuable at all at the end of the term. So inflation is a terrible enemy of mortgage-backed securities. So other than that, that's the big number, jobs number. Usually this is the headline news. Typically, if we would have had that number come out, had this Senate vote not be going on, this would be the headlines right now today, and we'd see stocks probably dropping and mortgage-backed securities going up. But that's not the case because obviously this House bill is more important on the news wires. So outside of that, I think that's oil's down again. It's $94 a barrel. We're continuing to decline steadily there, as well as the dollar still gaining ground. So a lot of good things. A big problem right now, though, is the credit lines are continuing to dry up. Right now, I've had 2 clients in the past week have their home equity lines frozen. So I just want to warn you, if you're watching this, if you have an equity line open and you think that you can access that money, I would pull that money out and get it into something like a money market or even into a bank account right now, just so you have access to it, because liquidity of your money is key right now. And I have a client that had a $200,000 equity line. They only had $40,000 used, anticipating $160,000 to be available for emergencies. They're in the real estate business, and as we know, that's a troubled area. He got a letter in the mail saying that his line is frozen at $40,000 and does not have access to the other $160,000. So if you think that equity line on your house is safe and it's yours, and you sign a document saying that that's going to be open forever, that's not the case. They can close that line down and freeze it to where it's at currently. So if you think that's a safety margin, make sure and understand they could pull the trigger today, and that would be the end of it. Also, auto financing is getting tighter. There's auto dealers around the U.S. that are struggling and commenting that they don't have credit lines anymore to even loan cars out or to give loans to people for cars. Leasing programs are pretty much gone. Any leases on big big trucks, SUVs are basically obsolete now. So if you went to go lease a car right now, most likely you're not going to be able to. So again, this credit crunch is really hitting a lot of different areas of our lives, as well as credit and the home equity line, like I mentioned. So that's the update for today, Friday. Like I said, if the House votes in this bill, most likely there won't be any big significant change because the market and the traders have already kind of priced that expectation in. If it doesn't pass today, then I'll probably do an update this afternoon because it's gonna the poo's gonna hit the fan. So have a great Friday. We look forward to serving you, and be blessed.